Hello and welcome to Value Research Podcast. You're listening to First Page, a column written by Dhirendra Kumar. When markets fall, look within. Costly investing mistakes reveal more about us than the market. We spend countless hours analyzing markets in the investment world, but the most critical variable rarely appears on our charts or spreadsheets: ourselves. As market volatility has intensified in recent months, we at 𝗩𝗶𝘂𝘂𝗲 have increasingly recognized that investment success depends less on predicting market movements and more on understanding our psychological responses. The correction between September 2024 and February 2025 offers a perfect case study. With over 80% of stocks posting negative returns, the real revelation wasn't about market mechanics but investor behavior. The stark difference between those who weathered the storm and those who suffered devastating losses had less to do with market knowledge and more with self-knowledge. This insight explains why our recent cover stories have shifted focus, examining not just what markets do, but how we react to them. The financial markets, after all, are less a mathematical system than a psychological arena where fear, greed, overconfidence, and herd mentality play out in real time with real money. When prices fall sharply, they expose vulnerabilities in both companies and decision making. Did we chase microcaps based on stories rather than fundamentals? Did we justify sky-high valuations with "this time is different"? Did we follow momentum blindly? These aren't just investment mistakes, they're cognitive biases. The patterns from this correction are depressingly familiar. The same psychological traps seen in past downturns reappeared with clockwork precision. Overexposure to speculative bets, comfort with inflated valuations, momentum chasing, sector hype, and IPO fervor. Their power lies not in novelty but in alignment with human tendencies. The cover story of 𝗩𝗶𝘂𝘂𝗲𝗏 May 2025 issue identifies 5 pitfalls that proved especially costly in the recent correction. What's striking is how each ties to a psychological vulnerability: our attraction to lottery ticket stocks, our disregard for valuation in favor of a good story, our habit of extrapolating recent trends, our love for hot sectors, and FOMO around new listings. Microcaps tap into the same psychology as lottery tickets. Life-changing returns cloud rational thinking. Valuation discipline often collapses under the weight of a compelling narrative. Momentum appeals to our belief that yesterday's trend will continue. Sector infatuation stems from wanting to be part of something revolutionary. And IPO enthusiasm? That's classic FOMO. These vulnerabilities are most dangerous during bull markets. When everything rises, these psychological tendencies are rewarded, not punished. As Buffett said, only when the tide goes out do we discover who's been swimming naked. Worse, these biases often interact and reinforce each other. The investor chasing momentum may also ignore valuation, pile into hot sectors, and eagerly subscribe to IPOs, a perfect storm of psychological weakness when markets turn. Building a resilient portfolio isn't just about picking the right stocks. It's about constructing a framework that accounts for our psychological weaknesses. By putting in place processes that demand critical evaluation of microcaps, valuation discipline, focus on fundamentals over price trends, understanding of sector cycles, and skepticism towards IPOs, we create guardrails against our worst impulses. This won't eliminate losses. Even disciplined investors face drawdowns, but it reduces the chance that temporary market declines don't become permanent capital impairments through panic selling or frozen inaction. As markets continue their unpredictable journey, perhaps the most valuable skill we can develop isn't market timing or stock picking, but self-awareness. Recognizing our biases, understanding our emotional responses, and building systems to counter them are more valuable than any market forecast or stock tip.